Never missing a payment is the kind of thing that gets your credit limit raised. Never missing a payment is also what being stuck looks like from the outside. In the data, those two people can be very hard to tell apart. When a credit limit increase arrives, it tends to look like a gift. It is not a gift. It is the output of a decision. Somewhere, information about you was read. A threshold was met. A number was raised. And nobody sent you the reasoning. The letter tends to open with congratulations. So the useful question is not whether banks are allowed to do this. They are. The question is why they would. Start with the size of the thing. There are around 39 million active credit card accounts in the UK. Between them, they carry roughly £72 billion. This is the market those decisions get made inside. And borrowing on a card has rarely been more expensive than it is now. In February 2026, the average advertised purchase rate on a UK credit card reached 35.8%, the highest since records began in 2006. That is the rate advertised on cards being offered, not necessarily the rate on every existing balance. But it tells you what kind of borrowing this is, because a limit is not storage. It is not money set aside somewhere with your name on it. It is an offer to borrow, at credit card rates, left permanently open. And there is a well-documented pattern about what tends to happen next. When the regulator reviewed the evidence on credit limits, it found that when a limit rises, debt tends to rise with it. Roughly 10 to 14% of the new room becomes new borrowing. The effect holds whether the customer asked for the increase or not. And it is strongest for people who are already close to their old limit. So, the ceiling moves. And on average, the balance quietly moves up after it. Which raises the obvious question. If that pattern is known, and known to the regulator, how does an increase get approved at all? The answer is that it does get checked. Genuinely checked. Before a firm significantly increases a credit limit, it has to carry out a reasonable assessment of the customer's creditworthiness. That is a rule, not a courtesy. And it applies specifically to raising a limit on an existing card, not only to opening a new one. The rules go further than that. When a firm runs that assessment, it is supposed to have regard to whether the customer is in financial difficulty, whether they have recently experienced it, or whether they are likely to. And since July 2023, a second standard has sat above all of it. Firms must avoid causing foreseeable harm to their customers. That is the actual wording. Avoid causing foreseeable harm. So there are real obligations here. It is worth saying that plainly because the story is not that nobody is watching. Here is where it gets difficult. The assessment is meant to ask whether the repayments are genuinely affordable, not simply whether they have been made, but someone who has paid the minimum on time for 4 years produces a very strong record, every month, on time, without fail. And whatever else that assessment weighs, a record like that is hard to read as distress. And yet paying the minimum, reliably, for years, is also very close to the regulator's own description of being stuck. The reliability is real. So is the thing underneath it. And in the data, those two situations can look remarkably similar. Before the rules changed, this was happening at a scale worth knowing about. In 2017, research found that 1 in 5 credit card holders had received an increase they never asked for. And among people who already described their debts as a heavy burden, nearly half increased their spending after an increase arrived. That research is nearly a decade old now. It does not describe today's market. It describes the problem the 2018 reforms were written to answer. And when the regulator finished its study of the credit card market in 2016, It wrote one sentence that explains a great deal. Firms do not have strong incentives to help customers out of persistent credit card debt. That is not an accusation of cruelty. It is a description of a structure. Nobody has to intend any harm at all for that sentence to stay true. So what happened after the rules came in? In the regulator's most recent Financial Lives survey, published in 2025, 5% of UK adults were in persistent credit card debt. That is around 2.8 million people. And it was 1 percentage point higher than 2 years before. The protections are real. The number is not falling. Both of those things are true at the same time, which means that if some version of this has happened to you, it is not 2.8 million separate failures of character. A number that size is telling you about a system, not about the people inside it. So it is worth knowing precisely what exists. You do not need to memorize any of it. It is enough to know that it is there. Since 2018, credit card customers have been able to opt out of automatic credit limit increases. How you do that varies between providers, but the right to ask is there. If you have been in persistent debt for 12 months, you should not be offered further increases at all. And persistent debt has a precise definition. It is worth hearing slowly. Over 18 months, you pay more in interest, fees, and charges than you repay of the actual debt. Not missing payments, not defaulting. Paying reliably in a way that mostly feeds the interest. If an account meets that definition, obligations switch on. At 18 months, the firm has to prompt the customer to change their repayment pattern if they can afford to. At 27 months, it has to remind them again. At 36 months, it has to propose a realistic way to repay faster. And if that is not affordable, it has to consider reducing, waiving, or cancelling the interest and charges. Then, the newest protection of all. Since 2023, avoid causing foreseeable harm is a standard your card provider is held to. It is worth knowing the name of it, which leaves one question you can actually answer this week. Not a question about the bank, a question about your own statements. Over the last 18 months, did more of your money go to interest, fees, and charges than came off the debt itself? You do not need a spreadsheet for this. Most statements show the interest and charges you have paid. Add up 18 months of them. Then look at how much the balance itself actually fell over the same period. If the first number is larger than the second, that is the definition in your own figures. And the reason to ask is not to grade yourself. It is that if the answer is yes, you are not simply behind on something. You are inside a definition that already carries obligations with it. Those obligations sit with the firm, not with you. Knowing the answer is how you find out whether they have been met. If the balance underneath it feels heavy, you do not have to work that out alone. Money Helper is free, confidential, and backed by the government. Their debt advice locator can connect you with real help. Online, by phone, or face-to-face. And if your own limit has been climbing quietly for years, this is the part to hold on to. Being reliable was never the problem. It was simply being read as the answer to a question nobody ever asked you. If this helped, you can subscribe for more calm explanations like this.